Don't forget, you can reach the latest episode of Potomac Watch anytime. Just ask your smart speaker, play the Opinion Potomac Watch podcast.
From the opinion pages of the Wall Street Journal, this is Potomac Watch.
Welcome back. The news on the inflation front this day. Here is the headline in the Wall Street Journal. The Consumer Price Index report shows inflation has been cut in half from last year's peak, declined to 4% in May, year over year. And Monet, the thing I'm always struck by reading these headlines in recent months is the framing of only 4% inflation, which if you had told people to expect that a couple of years ago, they would have thought that that was a little alarmist. And so I'm wondering how you read this report and particularly some of the numbers that go past the headline.
Right. I mean, I'd say in fairness to the people touting 4% as major progress, it is in the context of the peak that we reached last year. And there was an open question at that point how easy it would be to rein in inflation with interest rate increases. And given how high we had gone to 9.1% in 2022, the fact that it has declined to 4% is major progress and is a pretty clear indicator that the interest rate increases that the Fed has enacted thus far have had an effect on the economy the way that they were intended to do. The big question is whether people see that pace of decreasing inflation as a reason for the Federal Reserve to slow the pace of future increases. Everyone expects that at their next meeting, they're going to pause and keep the benchmark interest rate around 5.25%. But the question is, what does the outlook look like? And I think that there are many reasons to think that it might not continue to decrease, inflation that is, at the same rate that it has thus far. And that tends to be what you see when interest rate increases reach a certain point, that it becomes more difficult to close that remaining 2% gap between the target rate, which is 2%, and the current rate at 4%. And so now you could say is the tough part, because there are going to be more voices touting the progress that we've made and people urging the Federal Reserve to slow down and wait for previous interest rate increases to take an effect. But it's very possible that that last bit of progress between where we are now and where they hope to get at 2% is going to require several substantial increases in the future. And it's going to be difficult for them to stay the course when people are suggesting that now is the time for them finally to pause.
The other thing that sticks out to me here is core inflation versus overall inflation. And remember, economists talk about core inflation, which is inflation minus food and energy, because prices for food and energy bounce around for all sorts of reasons that are not related to the overall price level. And right now we're in a situation where we have core inflation above overall inflation. Year over year, it is 5.3% core versus 4% overall inflation. And that's because we've had some significant drops in May in energy prices in particular, if you're looking through this report. But if you look at the chart in the numbers put out by the federal government, overall inflation over the last year, you have a pretty nice downward curve in that line. But if you look at the core inflation, it is much flatter. And just over the last 6 months or so, here are the figures for just that month's inflation. This is not year over year. This is just the monthly figure. In December, 0.4, January, 0.4, February, 0.5, March, 0.4, April, 0.4, May, 0.4. That, Kim, looks pretty steady to me, and pretty steady at a level that is uncomfortable, I think, for the Federal Reserve and Joe Biden and consumers, frankly.
Yeah, and it goes back to your point of these kind of rosy media stories, which I think are far rosier than merit. If you look at those numbers you pointed out, Kyle, we had 0.4% up in April, and that is what economists are looking at as they try to figure out what is yet to come. And here's some of the things that have really stuck out. They've been looking particularly at what they call non-housing services. So those are services minus housing, and those really are related to what they view as a very tight labor market that we have right now. And a lot of those areas are still what are feeding that core number. So hotels, dining out, other things where people are involved and employers are having difficulty getting a hold of those workers, and they might be needing to pay them more than they normally would. And then that's being reflected back into the prices that they are charging customers. Those are the things that are feeding into those core numbers. And it's why I'll be really curious to see what the Fed does. There was a lot of cheerleading in the newspapers today suggesting that, well, when the Fed meets, that they probably will pause. This is, after all, they've done 10 straight hikes. This will be the 11th one if they were to do it tomorrow. But that, I think, could still happen, because if you really dig into this, it does suggest some real problems remaining yet in the inflation arena. And as I saw one analyst point out today, saying just because the numbers are dropped, it doesn't mean that you are anywhere near mission accomplished.
Monet, we'll give you the last word, but this also strikes me as a continued vulnerability for President Biden. And it's true that we don't have inflation anywhere near the year-over-year 9% figure that we were looking at back in the summer of 2022. But 4% and maybe dropping a little bit slower than it was previously, it's not a comfortable place for the president to be in as he's going into his reelection. And even if it gets down a little bit further, do you think that consumers will forgive and forget that 9% that they lived through last year?
Sure. Yeah. I think it's extremely unlikely that voters are going to forget that, even if inflation has decreased by a lot, that it was President Biden and the Democrats' policies that helped it to reach the peak that it did in 2022. Obviously, we had an absolute record amount of spending. Don't forget the stimulus that President Biden enacted in March of 2021 after taking office. This was at a point where the economy was already beginning to recover and where the pandemic was already beginning to recede. And yet President Biden seized the opportunity to direct quite a lot of spending to favored Democratic groups through that bill. And that was part of what helped to push inflation as high as it went. And Jerome Powell himself has said that the fiscal response to the pandemic was a big part of what pushed inflation so high. And even though it continues to decline, it still is concentrated in a lot of very visible areas. The price of airline tickets is one famous one that people have been focusing on recently. And the price of rents, as you mentioned, is reflected in the May inflation numbers. And so even though broad-based prices have begun to retreat quite a lot in terms of the pace of increase, consumers are still paying quite a lot in targeted areas. And every time they buy one of those airline tickets, they're going to be reminded that inflation still is nowhere close to where we'd like it to be. And that is going to, in fact, affect how people vote come November 2024.
Thank you, Monet and Kim. Thank you all for listening. You can email us at pwpodcast@wsj.com. If you like the show, please hit that subscribe button, and we'll be back tomorrow with another edition of Potomac Watch.